This is basically what that crash should have been. People didn't notice. It's pretty obvious. About a year and a half into that crash, the central banks just stepped in and just started printing money, unprecedented rates to blow us out of that. That's what basically happened. So that recession didn't really do its job of flushing out the greatest debt bubble in history, which I've been warning about for years and decades, bigger than the Roaring '20s, which ended up in a bubble in the stock markets, and the crash of a lifetime back then, now down 89%. For the Dow, which was the leading index back then. I'm predicting as much as 86% for the S&P 500 in this crash and 92% on the NASDAQ. So in that realm of something you only literally see once in a lifetime, if that. So this is nothing. This is what my point is. Most financial advisors are right most of the time. You can just sit through most corrections and rebalance and that sort of stuff because it's not easy to time the market, as most people know. Okay, but this is so important that I am timing the market. I warned about this in my newsletter, off the charts. 2 huge warnings in mid and late December saying this crash is about to happen. It is going to be the crash of your lifetime. And next thing you know, we were down 38% in the NASDAQ in October of last year. And that's just the first wave down. There's 2 more to follow. And I think we're just about to see, or we've already started the next wave down, which could take the NASDAQ down to 8,000 just in this next wave, not the end of it. And that's going to be down a little over 50%. And that's when people are going to know this is not a big correction. It is a major crash, one that you have not seen in 73, 74, or 80, 82 in your lifetime, and one that even the millennials will not see a bigger crash than this when their boom and bust hits many decades. Never before. Look at the Great Depression. Look at any major downturn. The mid-'70s. Never before have central banks declared war, literal war on recessions, and said, we will not let the economy fall. Mario Draghi was the first one to say. He said to traders who were shorting the European markets back there in 2020, when we should have had the real crash started, okay? He said, I will print unlimited amounts of money. Do not bet against me, you damn traders. And that's what they've done. They have pushed this off. But even with all this unprecedented $9 trillion for the Fed alone in money printing, never have we seen even a fraction of that, okay? Even with all of that, we keep falling back in a recession. We just came out of the COVID downturn, and with all this massive stimulus, $10 trillion, half of it fiscal, half of it monetary, the biggest single 2-year stimulus in all of history, topping everything before that, and we're already falling in a recession again. That's the problem. The economy underneath is really, really weak and really needs to get rid of a lot of really bad debt and zombie companies, and the central banks won't let the economy do its thing. Oh, we're free market capitalists. No, we're not. If you trusted the free markets, you'd let the free markets do what they do, and central banks have declared war on the free markets. That's the problem. And the free markets, thank God, look like they're going to win this. I've been fretting to my subscribers saying, I don't know if we'll ever have free markets again. I mean, this may never end. If the economy gets its way and we have this crash, it means the markets have taken back over. They're going to do what the economy really needs and not listen to stupid central bankers who never had sex or run a business. Find me one that meets either of those 2 definitions or looks like it. What are these people doing in charge in the first place? Okay? So that's what I see. The economy looks like, and that's why we're in a critical point right now. The economy is set by looking at the waves, and I've spent years and years studying what I call Elliott wave theory, brought by Robert Prechter. He's another good guy to interview, by the way. We're about to hit this third wave of the third wave, which is when the crash gets its most momentum. If that happens, if they can't stop this, and I don't think they're going to be able to stop it. I think it's going to creep up on them before they can reverse their tightening. That's what shows people, no, these guys do not have control of the economy. They're not able to stop this crash, and then they lose credibility. I was studying demographics for my new venture clients in the early 80s, I was managing and turning around small businesses, new ventures and new industries. So I was seeing the new economy emerging in the early stages. And I was seeing, most importantly, these people were not selling goods to aging Bob Hope generation people. They were selling back then to young baby boomers. So that's when I started studying the baby boom, how big a generation it is, when do they spend money, how they can impact the economy. And of course, the first indicator I came out with in 1988 was called the spending wave. And here's how simple it was, David. A 46-year lag on the birth index, which I adjust for immigrants, and I can do that accurately. I've got accurate statistics on the age of immigrants and how many have come in and how many are projected to. And it said greatest boom in history until 2007. And what happened after 2007? We hit 2008, the deepest downturn since the Great Depression, since 1930. And central banks panicked and have been printing money ever since to offset this great downturn. They don't understand what's happening. I predicted this would happen decades. All in the 80s, I wasn't just predicting the boom. I was saying 2008 through 2022-23 would be a weak period in between generational spending cycles, and particularly weak because the baby boom was such a large generation to peak and crash. And that's why these guys, they thought they were just going to print some money in 2009 and be done in a year. They've been printing ever since. Unprecedented. I think it's up to $9 trillion now. They've had to print unprecedented amount of money because the downward demographic forces are that strong, and they actually do turn up around 2024-25, but they've kind of pushed this downturn out longer by fighting it and not letting the markets do what they do best, clear out bad debts, clear out excessive valuations, so we can move on and have a healthy bull market again, which we always do when the next generation starts spending. So the next generation is going to start spending in the next year or two, but we have not cleaned up the massive debts and overvaluations of finance, the biggest financial asset bubble in everything. We've never had a financial asset bubble in everything like this. This bubble has not been allowed to burst and clear out its excesses, which we need to do. And I think we're into that process now. They overspend. I mean, now they're having to tighten strong. I mean, they're up to 475 basis points and probably going to be at 500 in the next meeting before they stop. That's more than they've pushed up interest rates and tightened ever since the early 80s. This entire boom and bust. So this is serious tightening. Why? They had to tighten because they overstimulated in COVID. That was their biggest mistake. Now they're tightening and they're thinking, well, the economy underneath can handle it. No, the economy underneath has been weak since 2008 and does not get strong until a few years from now. So I think that's how this correction, what looks like a correction now, keeps going down, builds on itself, and turns into a crash more like 1929 to 32, down 86% on the S&P 500. That's my best forecast at this time. And we've already seen the S&P down 28%, much more than a normal correction, and the NASDAQ down 38%. And I studied every major bubble burst in all of history for hundreds of years and found that a bubble does not end until you see a first crash of 28 to 50%. So that's what that crash last year was. Now we're moving in the next wave down. I call it, so you get a first wave down, a second wave bounce, which we've seen. We're already into the third wave, just starting. The third wave usually is the strongest and hardest wave, and I think that's going to happen. Most of that's going to happen between now and the end of the year, and the biggest part of that, I call it the third wave of the third wave. So the most powerful part of the larger third wave that we're already in is going to hit between now and about mid-June. So this is the time to be cautious on stocks. If you listen to me now, then you'll probably listen to me more down the road, but just listen to me now. This is a really good time to lighten up or get out of stocks and see if this crash happens. Because if it does, we could be down 50% on the NASDAQ from the top, literally by mid-June or so. And that's going to be very painful for investors. Well, it was caused by massive money printing, which did increase consumer spending. Consumer spending would have been much weaker. So they were literally pouring money into the economy to help offset the natural slowing. It's not that individual families are spending less. It's just you have less people moving into their peak spending, which again, I was the first to identify decades ago. 46 is the magic number. Now it's about 47 for the millennials. 46 is when the baby boomers, on average, spent the most money. So this whole boom was just increasing numbers of baby boomers moving to that peak spending. And ever since 2008, nothing wrong with the economy. Nobody did anything wrong. We have less such peak spenders, and that causes a natural slowing in what governments have done, because they only thought it was going to last a year or two in 2009. They thought 1 year of stimulus and we'd be out of that recession. They've had to continually stimulate the economy because it's a long-term, predictable, solid demographic slowing that you cannot cure except by printing money. And what the problem with printing money is, it creates financial asset bubbles, which then will burst badly. No financial asset bubble ever of this size, and this is greater than the roaring 20s, greater than the bubble, the tech bubble in the 99, 2000. No bubble has not burst and burst 80 to 90%. And that's what I'm saying can happen. And anybody that looks at this bubble and sees anything else is bubble blind. It just doesn't understand history, because this should be the most obvious thing on earth. We see a bubble now bigger and higher than the 95 to 2000 bubble, and people somehow think we'll come out of this with a soft landing. Last time, 2008, was not a soft landing. It was the deepest recession, deeper than 80 to 82, the closest thing to 30 to 32, but nothing will ever probably hit that again. But this is going to be stronger than that, because we didn't finish the downturn in 2008. That downturn should have lasted like 30 to 32 and well into 2010, and we should have had 15, 16% unemployment instead of 10 to 11, on and on and on. It didn't, so now we're going to see that in the second crash. In the Great Depression, the first crash was the big one. Then we had a second depression from 37 to 38 at the end. This time we get the big crash at the end here in the early 2020s, because we didn't let the first crash do what the economy would have loved to do, just clear out a lot of bad debt and zombie companies, which, David, as you know, both of those are at record levels. I can't even compare this debt bubble and the number of zombie companies, which they didn't even use to measure, companies that can't pay their debt service but can still barely be alive. We've never seen levels like this, which is a sign that the economy needs to take a break and flush out all these zombie companies and excessive debt that is unproductive now. Most debt now that was raised is not productive. The economy loves to flush that out to make us healthy again. Central bankers don't like recessions because they think they're the enemy, and they don't understand that it's exactly recessions that make the economy so damn efficient. Recessions are the cleaning agent, the rebalancing agent, every time we have a boom and things get a little overdone and sloppy and excessive and inefficient. The longer the economy booms, the more everybody lets their guard down. So recessions are as necessary as booms, and they don't last as long. They only last, about half as long as upturns typically, or less. So recessions are a good thing. And the way not to have a deep recession is don't have a crazy bubbly boom like we've gotten from overstimulus since 2009. This boom has all been stimulus. No demographics driving it. The boom from 1983 to 2007 was driven by the strongest demographic trends and technology trends in history. Okay? Even stronger than the 50s and 60s and the roaring 20s and early 1900s. So that was real. Everything since 2008 has been fake. And now we need to wash that out so we can see the next real trend, which is a shorter trend, but it's the millennial boom from 2020, late 2024 into late 2037. That will be their boom, and that boom will be compromised and not fully happen if we don't wash out the excesses from this baby boom. We had the boom and never let the bust do what the economy does so well, clean out all the excess.